China exposed stocks are losing ground. European companies exposed to China may falter on economic woes. What is happening right here and now? We are seeing that China, after 3 years of lockdowns, the expectation would be that everybody's going to rush out and buy anything and everything, that having an impact on Europe, of course. If LVMH, Louis Vuitton, they sell their purses and things, that people in China would be buying some of those. And all of these other luxury manufacturers and other types of manufacturing that was going on in Europe would obviously be exported to China. But if you're locking down entirely, people can't get to the stores, they can't buy the stuff. And so after 3 years, they said, hey, everybody's going to do this, but it wasn't exactly the case. I'm going to connect this in with what I'll show you at the end, which is basically when you stimulate, you create an effect on the markets. But when that stimulus isn't there, well, then the effect won't be there. I mean, it's pretty simple. I'll link these two things here. Stay with me. Stocks exposed to China may be at risk. Fading Chinese economic growth may weigh on performance. So if you have that exposure right now in your portfolio, I want you to look at this. And if not, maybe this is just something of interest to you. Whether that is LVMH, whether that is, you look down this, even L'Oreal, Adidas, Carlsberg, Mercedes, BMW, and so on. All of these companies have a lot of exposure to China. So we need to understand that, okay? Maybe we have an ETF, or maybe indirectly, right? Maybe it's a company that would basically give those parts to those companies. They sell the leather, or maybe they make the metal that gets then given to BMW or LVMH or what have you, and then it gets manufactured. So there's always going to be those connections, and we connect those dots together and realize that there's exposure here. If we do not believe, if the understanding is that we do not believe Chinese economic growth can keep up with the original estimates, well then, we look at this in this way. That's what I'm telling you here. At the same time, I want you to take, your own educated guess. Do you think we're more likely to go towards inflation or deflation? I want you to put that in the comments below so that, number one, we can kind of look through the comments between you and I, and we're going to see inflation, deflation, inflation, and we can get an idea. What do people think that watch the Money GPS? Are they more thinking inflation is going to happen, or is it going to be more likely deflation? And by the way, that could be a short instance of deflation with the response inflation. I would still consider that to be inflation because they won't let the deflation last very long. That's just the way I see it. So I'm going inflation in the comments below. Here we go. China is a big driver for German stocks. German and Chinese stocks' relative performance are closely linked. So I'm just showing you that here in chart form as well. So you got to understand all these dots connecting together. And we look at the United States. US manufacturing PMI, ISM manufacturing PMI. These are just different measurements. And those are the two at the bottom. Now, while we saw some, at least in the last little while, it was kind of improving, at least in manufacturing, but that wasn't exactly the case this time around. As we see, these are in contraction territory. Anything under that line, which is 50, it is a contraction. And you can look at the, this is directly from market, giving you the information that I think is important, but renewed decline in manufacturing sector conditions as weak demand drags on performance. It's just showing us that we are in a contraction. It had been coming down since really where things started to get real tough. Of course, when all that stimulus started to go away and they started to pull back on that. And the exact number here is below 50, so it is a contraction. But the point I'm trying to make is that we look at this at a time in which all of the stimulus has gone and they're looking for more of it, but we are in a quantitative tightening policy. And at the same time, we're really, really concerned about the bank crisis, okay, in reality. A wave of defaults and a recession is, quote, imminent, according to Deutsche Bank. Now, I thought this was an interesting one to look at because this has an extreme let's call it, I don't know if it's a black swan, but maybe a gray swan type event behind it, potentially. Our cycle indicators signal a default wave is imminent. The tightest Fed and ECB policy in 15 years is colliding with high leverage built upon stretched margins, according to their study. And so, what would the solution be, or what would the cause? What would the actual, in the end, what would happen? And that is, of course, I think it's pretty clear that when you encounter this and companies start failing, they can't pay their bonds, they can't pay their debt holders, everything starts to fall down, deflation. But then the central bank says, uh-oh, we got a problem. We're going to stop our quantitative tightening policy. We are going to stop increasing interest rates, and we're going to go in the other direction. That is the result. That's what's going to happen. That is very clear. We know this to be the case. Now, if they don't get right away, let's say tomorrow there's no bank crisis, and next month there's no bank crisis, and the stock market just keeps moving up and up and up and up, it doesn't resolve the issues that are there. The inflationary pressures are evident in these corporations. Now, their stock's going to do well, and the CEO is going to do good, and the shareholders are all fine as long as everything's all good. But when things change, that's when we have a problem. Now, you waited until this part of the video. I want to thank you. In today's day and age, where people can only watch shorts, you made it this far. This is the big one. Let's cover it in depth. U.S. reserve balances. What are we talking about here? This is what the Fed banks. This is essentially the amount of money pumped into the system in one method compared with the market cap. Now, I want to do an entire video about the money mirror method, but I am waiting for something because I want to clarify and codify this as best I can. But I think for the purposes of this video, we have to understand something. Money, as we look at it in the financial world, is actually pretty complex because, number one, it's produced out of thin air, as I just talked about it in a recent video, outlined that entirely. But also, it's coming through different means. And we can see that with, in this case here, U.S. reserve balances with Federal Reserve banks. So the money is being parked at these Fed banks. That's the way this works. Commercial banks can park their money there. And we get the same thing with, think about an individual depositing their money at a commercial bank. So the point here is that when you look at it and compare it with the stock market, it happens to correlate so well. If you look at the amount of money being printed, quantitative easing, if you look at the amount of money in circulation, take all of these things, in addition to the financial conditions. Are we tight? Are we loose? And you kind of roughly add all of these things together. I know that's a lot. I know it's a mouthful. But you take all of them and you put them all together. What do you get? That's the money mirror method. And essentially, we can see that over time, there's variances. But as they pump money into the system through one means or another, and by the way, if China's pumping, that could affect the US. If Europe is pumping, that could affect China. They all kind of slosh around in the financial system. But this shows us that if we just follow these things, we know when to put maybe more, if most people just do dollar cost averaging, but we know when to actually invest or when to kind of hold back using the money mirror method. It's much simpler to understand the details of the money mirror method versus trying to go out there and look at your favorite YouTuber and say, what is he investing in? Or follow my trades for $1,000 program when you could just follow the money mirror method. Now, many people have asked me for this, but when I get into it in depth, it's going to be very long and very detailed. At the end of this video, I'm going to show you something, so stay tuned for that. The other one I want to give you is China money growth leads commodity prices. So you could see China's real M1 year over year pushed forward 6 months. Okay, and that, it was up, it's down, all these different things. But we can see that it is sort of trending in the upward direction. So maybe, just maybe, that we can see that the commodity index, which is the black line, is due for an increase. Who knows? I really think if there's a bank crisis, if there's a fallout to some degree, that's going to be a problem for commodities because less will be required. But hey, we'll see. But this is it. You want to know what's going on? You want to understand very roughly what this is like the early version of the money mirror method. I talked about this years ago. This video is years old. It's called How the Global Economic Collapse Will Happen, brackets, explained in 60 seconds. It's a 60-second video before there were shorts, by the way. I think this was like 2019. And I did this video, and you could see it, and it's quite frankly very simple. I wrote the script out, and then I basically just read it, showing you this as the background to give you an idea of the way it works. It is very simple. Now it's gotten a little bit more complex because there's different layers to it, but this is the way it works. This is what you got to know if you want to be able to invest better than 9 out of 10 investors. It's a simple matter of this. I'm going to put it up on the screen. You can check it out. I'll see you there.